All right, it's time to put the last finishing touches on this partnership return here. Yeah, there's been so many changes lately. I just hope I got them all covered. Let's see. I've thought about all the changes under the TCJA. I think I'm good there. I'm reporting negative tax basis capital since it's still required despite IRS Notice 2019-66 delaying the positive tax basis reporting requirement until tax years beginning on or after January 1st, 2020. Oh, and I've got my Cpar form here documenting the taxpayers' decisions regarding the centralized partnership audit regime enacted under the Bipartisan Budget Act of 2015. And I just spilled salt all over my Cpar documentation. Actually, wait a minute. Speaking of salty Cpar, I wonder how all these states will handle the new regime for state partnership audit purposes. I know. I'll give Eileen Sherr at the AICPA a call. She'll know just what to do.
The question of taxation touches every home in America.
Cutting through the static of the tax world, it's Simply Tax.
I always like to start with just kind of a brief introduction, kind of who you are, what you do, and kind of what you do with the AICPA.
I am a senior manager at the AICPA Tax Policy and Advocacy Group. I've worked here for 25 years. I just had my 25th anniversary here. And before that, I was a manager with Deloitte's National Tax Office. Right now, I'm the senior manager to the AICPA Trust Estate and Gift Tax Technical Resource Panel and the AICPA State and Local Tax Technical Resource Panel, which is basically our committees. I also staff, as part of that, the AICPA State Partnership Audits Task Force, which has been working on this partnership audits issue since it got enacted in 2015. So we've been working quite a bit on it over the past 4 years.
Well, it's definitely an evolving topic and obviously kind of driven around some of the things that recently went into effect with the new partnership audit regime, kind of setting the stage here a little bit. Could you talk a little bit about the significant components there, particularly as they relate to, as we look to some of the state level adoption as well?
Well, first, I'll just mention at the federal level, Congress passed it in 2015, a new audit regime that differs from the TEFRA regime, where previously IRS had to audit each of the individual partners of the partnership. And now under the new federal regime, they audit the partnership itself. And it should be easier to assess and collect for the IRS. And that means probably the audits will increase of partnerships over the next few years.
I sat down with the late Jonathan Horn in episode 29 of the podcast to discuss the story of the Cpar and considerations for implementing it as of the June 2018 release of the episode, which we've included a link to in the show notes of this episode.
The new federal rules provide for an opt-out rule that you can just opt out of the regime for certain partnerships. And the default is that the partnership pays, but there's also a push-out election that is optional to push it out the adjustment to the partners.
Push it. We talk about that as well in episode 29 and in the other articles and resources that we've included links to in the show notes of this episode, which are available at bkd.com/simplytax.
There's one other big feature of the new partnership audit regime for federal purposes is now the partnerships have to designate a partnership representative. It's no longer the tax matters partner. It's the partnership representative, and they have authority to bind the partnership as part of the audit. They negotiate with the IRS for the audit for the whole partnership. So there's quite a bit of responsibility for the new partnership representative.
Having those conversations with, actually implementing on returns and talking to people about who that's going to be, that's a point that I think is obviously important to stress, but I think is also perhaps one that is sometimes not fully understood by those that are taking on that responsibility. Would you maybe agree with that?
Yes. And there's definitely, I'm sure there's been a lot of debates among partners within the partnerships as to who's going to be the partnership representative for federal purposes. And then for state purposes, they could designate a different person for each state or for all the states, or it could be the same as the federal.
What are some of the challenges that come about as a result of this new regime, again, taking it to that state level?
Basically, everything kind of cascades down to the state level from the federal. And in order for a state to assess and collect the revenue for their share of the adjustment or the liability that's flowing from the IRS audit, if they don't enact legislation, they would likely face substantial legal and administrative concerns. So they really need to enact legislation to be able to collect their share of what's coming out of the IRS audit. It's really needed so that they can administer the state taxes that's coming out of the federal audit. Most states have their own assessment and collection rules that are separate from the Internal Revenue Code. So even if they just conform to the Internal Revenue Code, it's not going to help their own assessment and collection rules of the liability coming out of an IRS audit. So they're going to need to update their own rules each state to collect their share of the liabilities from the IRS audit. There's also some unique state tax issues, such as apportionment, allocation, nexus, residency. We can keep going, that Congress really didn't have to consider when they enacted the new federal regime. So the states are going to need to consider that and figure out, is it going to be the review year, the adjustment year, partners, and where do you get your apportionment calculations from? And we think it should be the review year that's under audit. And we've worked with various other organizations. The AICPA has worked with the Council on State Taxation, COST, also Tax Executives Institute, TEI, the ABA SALT Committee, and Institute for Professionals in Taxation, IPT, and lastly, the Energy Infrastructure Council, EIC, which used to be the Master Limited Partnership Association. We've been working over the past few years on trying to develop a model statute that the states should consider, because without a model statute, we think there'll be a lot of substantial variation all over the country as to what the states are considering how to enact the rules.
Yeah, which is obviously definitely a challenge. And you were even alluding to that before, right? If you kind of have some options here and in terms of how it can end up working out, and it in part depends on the state or the jurisdiction that you're dealing with, right? And in terms of what options there are and how they're doing it. So then that becomes a challenge. Then if you're doing business in all the states, that now you've kind of have to chase down what does that state say and how does it adopt this and so forth, which obviously adds complexity there for sure.
Yes, definitely. Every state's unique. It's, I guess it's part of our system. And each state has, some states tax partnerships, some states don't. Some states tax individuals, some don't. So they each have their own unique rules as well. But as much uniformity as we could get makes it a lot easier for the taxpayers and the partnerships and partners to be able to deal with it, especially when the partnerships operate in multiple states and have to deal with every state.
Again, my own experience and talking to other practitioners and other businesses and business owners. I mean, there's obviously just been such an uptick in as of late with state level activity and notices and assessments and things like that are maybe coming out, particularly also in light of some of the recent Wayfair and so forth as things start to change and people start filing in more states. And so it just seems like there's a lot more activity. To your point, maybe things are going to increase on the federal partnership side as a result of this, but then, obviously there already is an increase in activity at the state level as well.
Yes, definitely. And the more that we can make things as similar to the federal and as similar to the other states, and it'll be easier for the tax authorities to administer it as well if people know what they're doing and are comfortable doing it.
Talk some about Multistate Tax Commission's model and maybe how it might address some of these challenges. Could you talk a little bit about that model and kind of what it provides for?
So basically, all these other organizations that I mentioned that we were working with, we came up with a model, and then we worked with the Multistate Tax Commission, MTC, and they went through their process, and they had a lot of input. I wanted to mention that definitely there's been a lot of input, not only from the practitioners and the taxpayers, but also from the tax authority. Many of departments of revenue were involved in the development of this model. And actually, the reason that we came up with the default within the model is that the partners pay, not the partnership. Originally, we thought it would be just like the federal, where the default is the partnership pays. But the states thought it would be easier to administer if it was just partners doing amended returns like they've always done. So we ended up with that in the model. But the best part about the model is that there's lots of options, and giving people the options to elect out or elect different than the federal treatment and different than other states. There's different options that we've built into the model so that you can either have the partners pay and it's being pushed out, or you can elect that the partnership pays and the state could deal with that as well. Also, there's a lot of state tax issues and best approaches that we built into the model with residency, nexus, allocation, and apportionment. In addition to the new regime for partnership audits, it would also allow for all federal audit adjustment reporting for all taxpayers to be uniform and for the states to adopt to clean up what we call the RAR provisions, the revenue agent report provisions for all taxpayers. So in addition to partnerships, it would also help with the reporting of all federal audit adjustments for all taxpayers. The bill also includes a clear definition of a final determination, which we think is when all the appeal rights are exhausted at the federal level. That's the time you would start the counting of the period from a final determination to report it to the state. And it also includes members that are part of combined and consolidated filing groups. So we considered that as well. It would establish 180 days as the standard period for taxpayers to report the changes to the states. And interest would still accrue until it's paid. So the states are not hurt or would not get at all hurt during that period. Absent a waiver, it would impose a limitation that the state could not change its statute of limitations, that it would expire both for the state and the taxpayer with regard to the federal audit changes. And it also provides equal and clear assessment and refund periods. So it's just laid out very clearly what the time frame is and when people need to act. The role of the partnership representative, as the default, it would be the partnership representative, but we also give the option that they can choose a state representative that's different. And the states would be fine with that as long as they know who it is. It allows the partnership to make different elections than they made at the federal. If they pushed out at the federal and they want to just pay it all together at the partnership level for the state and just be easier for them to deal with at the state level, that would be an option. We built in some modifications of the imputed underpayment. And we also covered tiered partnerships because I know that kind of makes things a little challenging to deal with when there's different levels of partnerships owning other partnerships. And in the model, you can make a different state election and file 90 days after the federal partnership for the tiered partners at the federal level. We also built in that estimated payments could be made to reduce the refund if it's overpaid. And again, that doesn't disadvantage anybody. And we thought that if the partnership has over 10,000 partners, there would be at least a 60-day automatic filing extension so that these huge partnerships have some time to deal with all that issues. And once the normal statute of limitations ends, then there could only be changes limited just to these federal audit changes that they just can't, it doesn't open up everything. And then there's a mutual agreement that if the partnership representative and the state want to suggest a different reporting or payment mechanism, as long as the state and the partnership agree to it, we think that would be fine. So it does have some flexibility to come up with alternatives.
Yeah, there definitely is. And thinking through all the different angles, like you said, and you'd mentioned kind of a core underpinning there is allowing some flexibility and some extra time, obviously. I guess what's the thinking behind that, and why do you think that's really needed in this case?
I mean, it's already complicated at the federal level, dealing with all the elections and the procedures and everything that needs to be done. So at the state level, it just multiplies, and dealing with multiple states and as much uniformity as we can get would be better. And as many options, the partnership or the partners may decide one option's better than another. And we really want to make it so it's administrable at the state level and that there's some uniformity as to what year you're talking about, what frame of reference the options are. We hope, as many states as possible will consider the model because we've really thought through what seems reasonable, both for taxpayers and for the administrators.
I mean, honestly, yeah, it's a win-win in a way, right? Because if better for the states and better for the taxpayers, if there's sort of a efficiency of experience of dealing with things, right? If the state's goal is to aid with the collection process, if that is in fact the case, it definitely would obviously benefit them as well. to that end, and again, a lot of those insights come from just getting the input from those that are doing it and thinking through the practical applications of this. But how has the AICPA been advocating for taxpayers and practitioners as it relates to this area?
Well, first of all, we think it's a priority issue for the profession that there's many CPA firms that are partnerships and limited multi-member LLCs, and a lot of their clients are partnerships. So there's a lot of CPA firms that are interested in the partnership area and will be undergoing these kind of audits. So we want to make sure that they and their clients have a reasonable method to operate. So it's a profession issue. And we think that there's going to be a lot of complications and burdens with compliance challenges if there's all these inconsistent requirements across the state. So as much as we can make it a good method that's consistent, it helps the CPA firms, we think. So the AICPA has been very active on this issue. We started off basically at the federal level, working with Congress right away. And in 2016, we submitted comments on technical corrections to the act, and Congress adopted many of our proposals. So that was helpful in clarifying different rules with the new rules. And then we also worked on a delay in the effective date because it was taking IRS a while to come out with all the rules and guidance, and it was going to be taking effect very soon. So we suggested a delay. IRS started working really, really fast and eventually came out with quite a bit of regulations on it. And we submitted lots of comments and testimony on it in October 2018, May, also back in 2017 in August. We submitted comments and testified at September at a hearing on the general rules. Even back in 2016, we also commented on the general rules. And just basically as different proposed regulations were coming out, including adjusting tax attributes, we tried to make the rules as workable as possible at the federal level. And then at the state level, we wanted to provide a lot of resources to the state's CPA societies. They advocate at the state level, the state CPA societies. So we came up with a position paper and a one-pager dealing with the state conformity to the federal partnership audit rules. So each of the states knew it was coming at state societies and could start working on it at the state level. Since then, now that the Model Act is out, we've definitely worked with the state societies on that. We've developed bullet points for them, and we have a website on partnership audit and adjustment rules that has all the resources that the AICPA has put together for anybody, our members, the public, and also for the state societies.
And how has that, I guess, been, again, because as you've kind of teed all that up, I mean, any comments or just kind of how it's been of going through that process? Because, I mean, that's a lot of work that's gone into that, a lot of reviewing, a lot of commenting. And I know what it takes to provide comments on those sorts of things. What's the experience been like for either you personally or the group?
And so I personally have been out to talk to several state societies doing presentations on this issue. Also, we've done webinars with the state CPA societies, and they're interested and appreciating any of the resources we can help. And we're just trying to get the word out. We actually also spoke at the National Conference on State Legislatures, State Tax Task Force on this issue to bring it right to the policymakers to let them know that this model exists and as they're considering it. And we think 2020 is really going to be a big year because the new federal rules started for taxable years beginning January 1st, 2018, which means it was the 2018 tax returns that were filed in 2019. And so now 2020, they have all the returns, and we think IRS is probably going to start auditing now that they have the information and they kind of have laid out the guidance that they plan to give.
It'll be very interesting, as you say, to kind of keep an eye on that and watch that, which I imagine you and your group will be doing, obviously, to monitor that and kind of hear and see again, if it actually happens, and then kind of what some of those things are.
Right. And there's been several states have already started to enact legislation. Back in 2016, Arizona was the first one, and that was way before the technical corrections even came out or the guidance from the IRS. So they're going to really need to update it to the new model, we hope. And then I guess the best state to look at that has enacted anything is Georgia. They have really followed the Model Act as much as possible, and it's a really good state. They enacted it in 2018, and also California. California made a little switch in the default. They made the same as the federal default with the partnership pays, but they still give the option to push it out. So those 2 states acted. And then there's been a few other states last year in 2019, Ohio, Oregon, and West Virginia pretty much followed the Model Act. So that was good. It was good to see those states. So now we have about 5 states that are following the Model Act. There was a few other states last year that moved ahead but didn't quite follow the Model Act. Maine and Rhode Island have enacted something, but they're going to probably need to make some changes, and we're talking to Rhode Island about that. And Hawaii, the year before, passed something. It pretty much adopts the rules for the state tax audits that are the same as federal tax audits, but it doesn't really take a federal adjustment and let the state assess and collect for their share of the liabilities coming from the IRS audit. So they're probably going to need to amend their statute to deal with that.
Do you want to know the up-to-date latest on the state legislative activity in this area as of the date of this episode? Stay tuned to the end of our interview here in a few more minutes, and I'll share the latest from Eileen and the AICPA on this evolving area. I guess if you're maybe a practitioner or somebody that's involved in CPA societies at the state level and are interested in either helping or knowing more about what's going on, what would you say? Any advice for how to go about doing that?
Definitely. Reach out to your state CPA society. If you want to get involved, I'm sure they would welcome any volunteers and any help they can get. If you know some of your policymakers there or your departments of revenue people, the more conversations we can have and the more focused on the MTC model and adapting it to each state would be really helpful. So I would say reach out to the state societies and try to work with them. Also, at the AICPA, like I said, we have a webpage on this issue that you can, as a starting point. And also the MTC has a partnership project page that includes the model there. So we have links from our website on the MTC website to get a start for where your state might want to go. And definitely, if your state's already considering it, pull up the draft legislation and try to get your hands around it and see what's going on. We welcome all people to get involved and try to make the rules better and more administrable.
There's a lot in there. There's a lot that's evolving and changing probably almost continually here, particularly as the states look to adopt some of these the suggested changes and get them implemented. Yeah, I don't know. Is there anything else that you would add maybe to the conversation or that everyone should be keeping in mind when it comes to this?
Try to follow the MTC model. If you have questions, this is one thing. If you have questions and you don't understand why something is the way it is, reach out to me. I'm here at the AICPA. Reach out to COST. There's people at COST that are working on this. Reach out to the state society and they'll get in touch with us. But if you have questions, we can explain why we thought it was drafted the way it was and how we came up with some of the solutions that are in the model. Don't just discount it that you don't understand and it doesn't make sense. Ask us and we'd be happy to have conversations about why the model is the way it is.
That's great. Yeah, we'll put your contact information in the show notes here to the episode so that people can find more, and the links also to those resources you were mentioning, because I think, the more you know here, the better, because it is complex stuff. You mentioned, again, some very nuanced, some very challenging areas for both taxpayers as well as practitioners, and having resources and people like yourself that can help to walk through and better understand that is so important right now.
Yes, I'm here and I'm happy to talk to anybody about this issue.
I really enjoyed our conversation. This was great. I appreciate your time. I appreciate all the work that you've been doing on this topic. I think it's definitely one that we'll probably also have to check back in with you on, because it will kind of be interesting to see how it all kind of comes out in the wash as some of the statutes are changed, and then also to kind of watch that activity as it kind of flows from and as a result of the changes on the federal side.
Yes, I welcome that. And thank you for this opportunity. It's been nice talking to you.
As you've probably already figured out by now, Eileen is a great resource on the latest of this topic of, I guess, what we'll call salty Cpar. and I called her up as we're putting the finishing touches on this episode to get the latest developments since they're fast moving, and I would encourage you to do the same if you're interested or are listening to the episode sometime down the road. As of today, March 5th, 2020, here's the latest on the state level developments so far this year. Iowa, Missouri, and Virginia are all considering bills that generally follow the MTC model. Indiana and Wisconsin also have temporary bills and will likely consider the issue again in 2021. And the AICPA is talking with the Wisconsin and Indiana CPA societies regarding the MTC model. Also, Minnesota has a bill that the Department of Revenue recently once again reintroduced, and the AICPA is working with the Minnesota Society of CPAs on their own version of the bill as well. And lastly, Eileen and the AICPA think there are a good number of states that may consider legislation in 2020, particularly after the states start to see the expected increase in the partnership audits at the federal level. These states include Alabama, Delaware, Louisiana, Kentucky, Maryland, Michigan, New York, and South Dakota. And there you have it, Salty Cpar. I'd like to once again thank Eileen Sherr for sharing her important perspectives and insights on the state considerations of the new partnership audit regime, as well as to frequent guest and friend of the podcast, Ed Carl, for introducing me to Eileen. At Simply Tax, we simply love hearing from listeners, and it would be great if you would let us know what you think of the podcast by dropping us an email at simplytax@bkd.com, leaving us a rating and review on Apple Podcasts, or connecting with me on social media. You can find me out on Twitter, where I tweet about tax at Damien Martin CPA, on Instagram, where I post about my life at the intersection of tax and being a dad at TaxDad, on YouTube by subscribing to our Simply Tax YouTube channel, and out on LinkedIn. I'm Damien Martin, and thank you for listening.
The information contained in this episode of Simply Tax is based on data available as of the date of its release. BKD is under no obligation to update this information if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances. Any information provided is not to be considered as tax, legal, or financial advice. Please consult your tax advisor before acting on any matters covered.